It's a so-called super week in terms of interest rates, with half of the G20 members making decisions on borrowing rates, including the US, Japan, China, the UK, and Sweden. In fact, the UK ended its run of 14 straight increases on Thursday. For more, we're joined by Professor Kim Hwa-gyun this morning. Welcome.
Good morning. Hi, how are you?
Good, how are you?
Good.
I'd like to start off with the U.S. The Federal Reserve kept its borrowing rates unchanged on Wednesday. Now, that leaves the gap between the key rates of South Korea and the U.S. at up to 2 percentage points. Now, what does that mean for South Korea?
Well, it has major implications for exchange rates and also the interest rate as usual. The interest rate actually is hold in case of the Fed. Therefore, it doesn't have much message actually to the Korean economy. But because the Fed officials and also the message actually was very hawkish, so that they can always increase the interest rate unless the inflation goes down below 2%, that actually sets the expectations about the longer term. And that actually is a concern for the exchange rate. And as you can see, the exchange rate has been fluctuating. So the US dollar to Korean won has gone up to more than like 13.40 or something. The issue actually is normally if high exchange rate actually is happening, that's not a big issue because export actually price is cheaper. But now because the oil prices are higher and raw material prices are higher, if the South Korea has to import lots of these raw materials and oil prices, that's going to increase the cost of production, and also it's going to increase the inflation. And that gives a dilemma to the Bank of Korea, because if they try to increase the interest rate to cope with that, then that's going to hurt the financial economy. So there's some trade-off now.
Right. Now, we also have to talk about China. Last month, China lowered its one-year loan prime rate by 10 basis points to 3.45% because of worsening economic woes. What's the situation like in China at the moment?
This time they just decided to hold, but clearly there was a surprise, the lowering the interest rate, and clearly that shows the signal that the Chinese economy is not in good shape. And I think still that's going on, although there's some sign of recovery. Still, the speed of the recovery is very slow. And also, their financial market has even bigger problem compared to South Korea because of the big loans and all this, real estate issues. So it's going to be very uncertain for the time being, especially the U.S. interest rates as a whole, but they may be hawkish for the time being. So there will be some gaps between the Chinese interest rate and the U.S. interest rate, and that's going to have some pressure on the Chinese yuan and also the other issues. So it's uncertain, and probably until next release of the data, there will be a lot of uncertainty for Chinese economy.
I see. Professor Kim, correct me please if I'm wrong. Most countries are likely to freeze their interest rates, it looks like. But the Bank of England finally ending its rate hike run. But rate hikes are possible for countries like Sweden, Norway, and Egypt. Why is that? What's the situation in those countries?
In fact, actually, the Sweden actually and Norway increased the interest rate just now. So clearly, they were worried about inflation, and also the oil price is going up. Therefore, they, in case of the Sweden, actually they increased the 8 times or 9 times in a row. They increased the interest rate, and the main worry is similar to South Korea. First is inflation, and the second is the Swedish krona has been weakened a lot, so they're worried about that. So they just try to increase the interest rates.
Interesting. Now, speaking of soaring oil prices, now oil prices could hit $120 a barrel due to further supply cuts. Now, that's according to JP Morgan. What's your take on this daunting outlook?
Volatility is going to be there, although I think the JP Morgan's the prediction is a bit too pessimistic. But still, I think it is possible that between 90 and 100, I think there's definitely a possibility, because the Russia-Ukraine war and also winter is coming, right? So these kind of things actually will have pressure on the supply. So for the time being, the bumpy ride is going to be expected. But at the same time, depending on the war situation, it can drastically improve as well. So rather than betting on the direction of like going up, I think there's more chance of like high volatility for the time being, at least 1 to 2 quarters.
I see. Then before I let you go, Professor Kim, I know this is a very difficult question, but when will oil prices actually finally be tamed?
Well, it's always difficult, but I think, the oil price is partly determined by these OPEC plus countries, negotiations and the tacit or implicit kind of the coordination of the prices. So clearly the Russia and Saudi Arabia actually reached a deal so that they just reduced the supply. I think that's one of the big reasons. So typically this type of thing duration is 2 quarters or something. So until then, I think usually well maintained, and some other countries kick in and they start increasing the supply, therefore price war can occur. So hopefully I think this happens earlier than I think within a quarter, but most likely 2 quarters or something.
That was a helpful answer. All right, Professor Kim Hwa-gyun, thank you so much for your insight this morning. We appreciate it.
My pleasure.